Hey guys, Max here, and this is your daily update for yesterday, the 2nd of January 2022. Of course, we had some big news from Tesla that we will cover, a few developments from the East in China as usual, some trouble with inflation in the US, so let's just get right into it. So it is Monday, which means most markets were closed, but US futures were rising across the day, and the dollar was strengthening as well, giving the US a nice little start to the new year. We saw a similar amount of limited bullishness in a couple other markets, like in Europe, where the Stoxx 600 rose 0.6%. Oil prices were remaining relatively high, hovering around $76 a barrel, suggesting that the markets aren't expecting any hits to demand from Omicron. Fears surrounding the demand for oil have pretty much completely evaporated now. In the crypto markets, it's more of the same. No new news, no real changes. Bitcoin still sitting at around about $47,000 and Ethereum at about $3,800. Now, whether these prices are being manipulated or not, there seems to be a lot of support for these price levels, and it's probably going to take an external shock, something like news of India bans Bitcoin, to cause any major changes in the market right now. The asset is still risk on, it's still highly correlated to traditional financial markets, so it will definitely be interesting to see what happens when the Fed's asset purchases end and when interest rates start to rise. To be perfectly honest, I think it will be bad news for crypto, but as I usually stress, these markets are new and so volatile, so no one really knows what's going to happen, and if someone claims that they do know anything about crypto for 100% certainty, then they're lying to you. Now onto the big news regarding Tesla. There was, of course, a very big delivery announcement yesterday, which is rightfully getting a lot of attention. Last quarter, they delivered 308,000 cars, which is their biggest ever quarter, and it's about a 15% beat of the average analyst expectation. Now this is a little bit off topic, but I don't really understand why analysts get these predictions regarding Tesla deliveries wrong so damn often. I literally can't remember a time when they were actually accurate. Now I don't know all of the data that they have access to, but considering how much capital is allocated to Tesla, stock and options as well, I'd have thought that the big investment banks would want their information to be as accurate as possible. Now I don't know if analysts have been getting fired over these mistakes, but to be honest, they should be. Tesla is delivering physical cars. We're not talking about software sales or Netflix subscriptions. The data in the world exists. Physical trails are left by Deliveries, and if JP Morgan and Goldman Sachs can't work out how to interpret the data they have, then I don't know what the hell they're doing. Anyway, that little detour in the past, this is really good news for Tesla, as I'm sure you can tell. Their deliveries for the year was just above 936,000, which is almost 90% higher than 2020, which is obviously some really strong growth. Again, analyst consensus was 263,000 vehicles, and even the very bullish predictions by some big Tesla bulls were rarely above 300,000, so this is a huge win for Tesla. This is also after an email emerged some time ago from Elon to the workers of Tesla telling them that they should no longer be working especially hard in the final couple weeks of each quarter, as the company would no longer be pushing out the best financial data possible, as it just wasn't necessary anymore. Now, the cynic inside me says that just because this email got leaked doesn't mean it's actually the truth. This could be a play to make the results seem even more bullish than they already are, and Tesla does have this rush culture that goes back years, so I don't know how quickly that is going to disappear. But if that is the case, if this is an actual real change of policy, then this quarter was even better than it already seems. Now on this news, Tesla shares obviously rose pre-market. I think at the time of making this video, they're currently sitting up about 7%, which isn't too surprising. With news like this and a stock as volatile as Tesla, this is exactly what you would expect. So now it's time for my unsolicited opinion on Tesla the company and then Tesla the stock. Firstly, they've done pretty damn well to continue to grow at this pace while the chip shortage has hampered countless other companies and businesses. The reality here is probably that Tesla was forecasting huge growth far into the future regardless of COVID long before it happened, and regarding the chip shortage, they had agreements and production in the works for more and more chips every year anyway, so they've basically been first on the list for all of these in-demand products. The second thing I want to mention is that yes, EVs are getting more popular, but there's a big difference between EVs and Teslas, and I don't think it's fair to just count Tesla's demand down to people want electric vehicles. I think Tesla's brand presence and marketing is absolutely top dollar. I know someone's going to comment down below and say, actually, Tesla doesn't have a marketing department. And yes, fine, you're right, technically they don't, but that doesn't mean they don't market their products. Sending a Tesla Roadster into space is marketing, and it's actually very expensive marketing. Tesla's Battery Day is marketing. Just because Tesla isn't explicitly telling you that something is an advert, just because they're not buying space at the Super Bowl, doesn't mean they're not marketing their products. Now, the next thing to mention is that it does seem clear that Tesla is still supply limited, which means that pretty much every car they can make, they can sell. And so building a new factory instantly means selling more cars. And Tesla is, of course, building more factories, so that's great. More deliveries are going to be coming. There will, however, be a day when Tesla is no longer supply limited. There will be a day where everyone who wants a Tesla has one, whether it's 1 year in the future or 100 years. That day will eventually come, and how the company reacts to that will be very interesting to see. As for now, though, the company is nothing but bullish. Yes, they have quality control issues. Yes, the steering yoke is just an awful idea. And yes, they don't see the real-life range that they claim. But the cars are selling like hotcakes, and they're growing production at a crazy rate as well. And I can't see an argument for being bearish towards the company itself. Now, despite all that I just said, I'm not buying Tesla stock for one reason, and one reason only, and that's I don't think the price is fair. It's that simple. If it were cheaper, I'd buy it, and I'd love to buy it, but not at this price. Even with all these crazy strong results, I still can't find a justification for the current share price, and that's been the case for a while now. You guys know me, I don't care about hype, I'm not looking for a momentum stock, and I'm not looking to get rich quick. I have a certain level of risk tolerance, and Tesla simply does not fit that profile. The best way I've seen it phrased is Tesla is an incredible business, but it's not a good investment. And with that, I'm sure I've annoyed a lot of people, but that was probably far too long on Tesla alone anyway. So let's move on into inflation. Of course, it's still around and kicking, but there is some cautious good news from the UK, who, if you remember last month, actually raised interest rates a little bit. Now, the gauge for market expectations for inflation has started to ease or decrease, which I don't want to be too optimistic about because we haven't actually got that data yet. But if that is the case, then this is brilliant news all around the world, because it might mean that even small interest rate rises are sufficient to curb inflation, or at the very least, to stop it from getting worse. Now, over the course of this week, we are getting loads of PMI or Purchasing Managers Index data from Europe. We're also getting a bunch of CPI or Consumer Price Index data, and even some unemployment data from Europe as well. So we should get a pretty good idea of how the continent is faring. I personally am expecting inflation to be very high in mainland Europe. The ECB has been asleep behind the wheel, adamant that inflation is basically non-existent, and that even if it did exist, it wouldn't be something that they could tackle. Now, speaking of inflation, Biden is due to announce plans to supposedly help reduce inflation in the US by attacking the meat processing firms and blaming them for surging prices. Now, this is peak realpolitik: create a problem, excuse yourself of all responsibility, blame it on someone else, claim to be the savior by attacking the supposed culprit. We've seen tweets come out from people like Pelosi and Warren blaming inflation on greedy companies and pandemic profiteers. And of course, these people aren't stupid enough to believe what they're saying, but this stuff polls well with their demographics. People with blue hair on Twitter hear greedy companies and they go mad for it. They hear that Biden is fighting those greedy companies and they cheer, completely unaware that it's Biden and his administration who is causing these people to suffer under these rising prices. This is all very sad to see. The supposed intervention by Biden will also not do nearly enough to actually combat rising prices. He's supposedly going to try and increase competition in the meatpacking industry by funding some smaller firms. And that might have a very small positive impact on prices, but that's going to be exclusively limited to 5 or 6 products. And in the long run, the subsidies that they're basically going to be giving these companies will stimulate inflation further. Now, over in China, we have some bad news. I know, what a shocker, bad news in China. Anyway, all of a sudden and without any warning, Evergrand halted trading on the stock exchange again. Now, at the time, no one really knew what happened, but it was clear that some bad news was going to come out, and if the stock wasn't halted, it would have crashed again, so the authorities preempted that and shut it down first. We then had some news come out that Evergrand had been ordered by Chinese authorities to tear down some apartment blocks in Hainan province. This sent shocks across the market, and obviously Evergrand shares were halted, so they didn't see any changes, but other property developers basically crashed again on this news. Shamal, for example, a company that I've spoken about in the past, which will default and collapse at some point in the future, well, its shares fell 6% on this news instantly, despite the fact that it had nothing to do with the news directly. So what's really going on? Well, 39 apartment blocks have been ordered to be torn down because apparently their permits were acquired illegally. Now, all of these buildings were built by Evergrand, and so the impact should be limited to Evergrand itself, but this isn't about those specific apartment blocks, this is about the CCP's actions and their intent. Firstly, the CCP is claiming that Evergrand got the permits to build these blocks illegally, which, to be fair, isn't an unreasonable thing to say. Bribery and corruption is rife within China and the CCP. The problem is that this is a problem with the CCP, not with Evergrand. If a government official is corrupted, you don't leave them in power and exclusively target the company involved. The reality here is that this is about optics, and the CCP is trying to make Evergrand out to be an evil company whose problems are all its own doings. The CCP is ensuring that there is a fall guy, that it isn't their fault, and that the citizens of China have someone else to blame. The reason this is bad for the whole industry is that the chances are it won't stop here. The CCP will target other firms like Fantasia, Cynic and Shimao as well, and they will all be blamed for the collapsing housing market that China is currently experiencing. This move represents an even tougher CCP, an even stronger crackdown against property developers, less support for those developers, and more pain to come. Funnily enough, all my predictions about China are continuing to come true. The housing market is falling apart and the tech crackdown is continuing as well. Hong Kong stocks have had their worst start to a new year in 3 years, as their first day of trading was very poor. Some of the big names in China, supposed value plays that I've warned people against investing in countless times, Alibaba for example, is down 3% on the day, on top of the 60% drop from its all-time high it's already seen. Sentiment for these Chinese tech firms is still very weak, mainly from fears that the CCP is going to hit them again and continue to damage their businesses, but also just from fears about China's economy in general. They have a 100% deadly strict lockdown in the city of Xi'an, and it doesn't even seem to be working. It's emerged that the Chinese vaccine does not protect against the Omicron variant even with 3 doses. And consumption across the entire country is falling. Bridgewater Associates, which is run and founded by Ray Dalio, the infamous China bull, had an awful year, getting absolutely ruined by the benchmark, missing it by 19%. That means if you just chucked your money in an index fund as opposed to giving it to Ray Dalio, you'd be 19% richer in 1 year. Ray Dalio actually lost 12% in 2020 as well, a full-on negative return, while the S&P 500 returned 18%. Over the last decade, his flagship fund has returned an average of 1.6% a year. That is utterly awful, and a big part of that is because Dalio insists on investing in China. Now I know it's not good to be smug, but I can't help but laugh just a little bit at the fact that this man who denies any wrongdoings of China is performing so laughably bad, especially in light of just random people picking random stocks and seeing returns of 20%. Maybe it's just time for Dalio to retire, and once again, just stay away from China. It's just not worth the risk. Now that is it for the day. Of course, we will be back for tomorrow. Markets are open today, so there should be lots to talk about, lots of drama, and hopefully a good video for you all to watch. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting then make sure to check it out. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.